Welcome, deep divers. Ever really stop to think about how money, moves in an economy, I mean? It's not just about, what's in your pocket or even the big government budgets. Finance, it's truly the backbone.
It absolutely is. It underpins everything.
Exactly. Affects everything from, say, a small business getting off the ground to huge infrastructure projects. So today we're asking, how does this whole dance of money actually happen? Specifically, let's look at India.
Right. And that's where a country's financial system really steps in. Think of it like the economy's circulatory system. Its job is to gather up savings.
Mobilize them.
Yeah, mobilize savings and then allocate those funds where they're most needed. This whole process is, it's vital for creating wealth and driving economic growth. So our deep dive today, we're zeroing in on two really critical parts of India's system: the money market and the capital market.
Okay. So our mission is to sort of demystify these sometimes pretty complex sounding markets. We want to unpack what they do, who the main players are.
And how they shape things for everyone.
It's exactly how they shape financial life for all of us, sometimes in surprising ways. We'll try to distill the key insights, give you that shortcut to being, genuinely well-informed. So let's get into it. Right, let's start with the basics then. What exactly is a financial market? Lay the groundwork for us.
Okay, so imagine a bustling marketplace, a very busy place.
Go ahead.
But instead of, apples and oranges, people are buying and selling financial assets. Things like bonds, stocks, government IOUs, securities. And this whole market, it operates through a network of institutions, banks, obviously, but also mutual funds, insurance companies, brokerage houses, the works.
And you mentioned two key types earlier, money market and capital market. What's the core difference there?
Yes. That's the fundamental split. The money market, think short term.
Short term.
Okay. Yeah, we're talking about lending and borrowing for, say, 1 year or less. It deals in what's often called near money.
Near money.
Meaning instruments that are super liquid, you can turn them into cash really easily. They're generally low risk and highly marketable. Good examples are Treasury bills, T-bills, basically short-term government debt, or commercial papers, which companies issue, and certificates of deposits, or CDs, from banks, all short duration.
Okay, short-term, liquid, lower risk. Got it. So what about the other one, the capital market?
Right. The capital market is the complete opposite, really. It's the market for long-term funds.
Long-term, more than a year.
Exactly, typically more than a year. This covers both equity buying shares, ownership in a company, and also long-term debt, like corporate bonds. This market is absolutely crucial for funding those big long-term investments. Think infrastructure projects, businesses expanding their factories, R&D, the kind of things that fuel real sustainable economic growth.
So one is for the day-to-day cash flow needs, the other for the big picture, long-haul stuff.
That's a good way to put it, short-term liquidity versus long-term investment.
Okay, so what does this all mean for you, the listener? We've got short-term, long-term.
Yeah.
How does this actually play out in, say, India's economy? Let's maybe dive into the Indian money market first, get a feel for those immediate rhythms.
Sounds good. What's really fascinating about the Indian money market is its unique dichotomous nature.
Dichotomous, meaning?
It basically has a dual structure. There's a highly organized sector, regulated institutions, and then there's a more traditional, informal, unorganized sector. And while you find money market activity across India, Mumbai really stands out. It's the most active hub, drawing in funds from everywhere.
Right. And at the very top of that organized sector, the big player has to be the RBI, right? The Reserve Bank of India.
Absolutely. The RBI is the central bank. It's the apex, the guardian of the whole banking system.
And it has quite a history, doesn't it? Established back in 1935, then nationalized after independence in 49, that tells a story in itself about building financial stability.
It really does. It shows a long-term commitment to having a strong financial core. And the RBI performs several absolutely critical functions.
Like what? What are its main jobs?
Well, first off, issuing currency. It has the sole right to issue all banknotes in India, except for the 1 rupee note and coins, those are the government. And to maintain confidence in the currency, it follows a minimum reserve system. It has to hold substantial reserves, currently about 200 crores, with a good chunk, 115 crores, in gold. It's about backing the currency.
Okay, issuing money. What else?
It's the government's banker, manages transactions, public debt for both the central and state governments, acts as their agent and advisor too.
Banker to the government. Makes sense.
And it's the banker's bank. It oversees all the commercial banks, requires them to keep cash reserves, acts as a lender of last resort if a bank gets into trouble.
So it supervises the banks.
Yes, and controls them to an extent. And perhaps most importantly, it's the controller of credit. It influences how much money banks can lend and for what purposes.
How does it do that? Control credit.
Through various tools. There are quantitative methods. These affect the overall volume of credit. Things like the bank rate. That's the rate RBI lends to banks. Or open market operations, buying or selling government bonds to inject or withdraw money. And reserve requirements like the CRR and SLR.
Okay, broad strokes.
Then there are qualitative methods, which are more targeted, like setting margin requirements for loans against certain securities, basically encouraging or discouraging lending to specific sectors. It's about steering the credit flow.
Fascinating. So below the RBI in this organized structure, we have the commercial banks. I always think of them as the intermediaries connecting savers and borrowers.
That's exactly their role. They are the bridge builders. Their main jobs are, 1, accepting deposits.
Like current accounts, savings accounts.
Right, those are demand deposits. And time deposits like recurring deposits and fixed deposits or FDs.
And the second main job.
Granting loans and advances, different types, cash credits, overdrafts, term loans, using those deposits to fund borrowing needs.
Okay, deposits in, loans out.
Well, yes, but it's more dynamic than that. This leads to a really crucial concept: credit creation.
Credit creation, you mean they make money?
In a sense, yes.
Yeah.
Not printing it, but expanding the money supply. See, when a bank gets a deposit, it only has to keep a fraction as reserve.
Right, the reserve requirement.
Exactly. The rest, it can lend out. Now, when that loan money is spent, it usually ends up being deposited in another bank or even the same bank. That new deposit is called a derivative deposit, and the bank receiving that deposit can then lend out a portion of it. This process repeats itself across the banking system.
Ah, so the initial deposit gets multiplied.
Precisely. It creates a ripple effect, expanding the total amount of credit and therefore money in the economy. It's fundamental to how banking works.
Okay, that's a key takeaway. Beyond RBI and commercial banks, you mentioned other organized players.
Yes, briefly. We have cooperative banks. They're really important for local needs, especially serving small and medium income groups. Farmers often have a 3-tier structure: local, district, state level.
Right, focused on specific communities.
Then, development financial institutions, DFIs. Think IFCI, set up way back in '48. Their goal was providing medium and long-term finance, particularly for industry. Some, like ICICI, actually evolved into universal banks through mergers.
So they expanded their scope.
Exactly. And finally, the Discount and Finance House of India, DFHI. Its specific role is to provide liquidity for money market instruments, making them easier to trade. Helps keep that short-term market running smoothly.
Okay, so that's the organized side. What about the other part of that dichotomy you mentioned, the unorganized sector?
Right. This is the more traditional, less regulated side. It mainly includes indigenous bankers. These are individuals or firms that have operated for generations, often dealing in traditional credit instruments like hundas.
Fundus, like an IOU.
Sort of, yeah. Traditional bills of exchange or promissory notes. Then you have moneylenders, common especially in rural areas, historically known for charging very high interest rates, though RBI has tried to curb their influence.
Because of potential exploitation.
Exactly. And finally, there are various unregulated, non-bank financial intermediaries, things like chit funds, a kind of rotating savings and credit group very popular in places like Kerala and Tamil Nadu, and needy funds, which are basically mutual benefit companies lending only to their members.
And the main issue with this unorganized sector is?
The big problem is the lack of coordination. They don't really operate under the RBI's direct control or integrate well with the organized sector. This leads to, as the source material notes, disintegration and lack of transparency.
Which sounds like it could cause instability, maybe different interest rates in different parts of the market.
Precisely. It creates inconsistencies and potential risks.
So despite these complexities, what's the overall role of the money market in India? Why is it so important?
Oh, it plays several vital roles. First, it meets the short-term financial needs of businesses, government, individuals, managing temporary cash flow gaps. Second, it's crucial for overall liquidity management in the economy. Third, it helps the government fund its short-term needs through instruments like Treasury bills. And perhaps most critically, it's the primary conduit for the implementation of monetary policy. When the RBI changes interest rates or reserve requirements, the effects ripple through the money market first.
Okay, so it's essential plumbing for the economy's day-to-day functioning. But you mentioned problems. What are the main hurdles the Indian money market faces?
Well, that dual structure itself is a challenge. The organized versus unorganized sectors lead to volatility and a lack of uniform interest rates. It's not one single integrated market.
Right, the transparency issue again.
Yeah, and there's often a shortage of funds. This stems partly from inadequate savings levels in some areas, but also, surprisingly, less developed banking habits, especially rurally. People might still rely on cash or informal channels.
Which leads to that lack of financial inclusion we hear about.
Exactly. Large segments of the population might not have easy access to the formal financial system and its benefits.
Have there been efforts to fix these problems? Reforms?
Oh, absolutely. Significant reforms have been introduced over the years. New instruments were brought in different maturity T-bills, commercial paper, CDs adding depth. The RBI introduced its liquidity adjustment facility, using repos and reverse repos daily to manage liquidity much more actively. Interest rates have largely been deregulated, allowed to be set by the market.
Letting supply and demand play a bigger role.
Yes, and huge improvements in payment infrastructure systems like NEFT and RTGS have made money transfers incredibly fast and efficient compared to the old days.
Okay, so a lot of modernization efforts. Now let's shift gears. If the money market is about the short-term flow, what about the long game, the big investments? Tell us about the Indian capital market.
Right. The capital market is where the action is for long-term finance. Its main job is mobilizing long-term savings and channeling them into productive investments, especially providing equity capital for businesses.
Equity capital meaning ownership stakes, funding growth.
Precisely. It helps companies raise funds by selling shares, allowing them to invest, expand, innovate, create jobs, all the things that drive long-term economic progress.
So how is this market structured?
It also has distinct parts. First, there's the government securities market, sometimes called the gilt-edged market.
Gilt-edged, because it's safe.
Generally considered very safe, yes. It deals in long-term securities issued by the central government, state governments, sometimes public sector undertakings, usually fixed interest. Then, the big one for companies is the industrial securities market. This itself is divided. You have the primary market.
Like for new shares. Like IPOs.
Exactly. Initial public offerings, when a company sells shares to the public for the first time, or follow-on public offers, FPOs, new issues. And then there's the secondary market. This is where existing shares and bonds already issued are traded between investors.
So the stock market, basically.
Yes, this functions mainly through stock exchanges. The big ones in India are the BSE, the Bombay Stock Exchange, and the NSE, the National Stock Exchange. And within this capital market ecosystem, you also have those DFIs we mentioned earlier playing a role, plus various financial intermediaries, merchant banks helping with IPOs, mutual funds pooling investor money, leasing companies, venture capital firms, funding startups.
It sounds like a complex web, but crucial for getting long-term money where it needs to go. What are the key roles it performs?
Well, number one is mobilizing those long-term savings from households, companies, institutions, pooling them together.
Okay.
Number two, providing that vital equity capital to entrepreneurs and established businesses. Number three, enhancing operational efficiency. Modern capital markets aim to simplify procedures, reduce transaction costs, speed up settlements, make it easier and cheaper to invest.
And for investors.
Crucially, it enables quick valuation. Stock exchanges provide continuous trading, so you get a real-time price for your shares or bonds. Transparency about value.
Makes sense. But like the money market, I assume the capital market isn't perfect. What are the challenges it faces?
No, it definitely faces challenges. One major issue historically has been financial scams. Unfortunately, there have been instances that have really shaken public trust and led to significant losses for investors.
Yeah, those headlines can be damaging.
Very much so. Then there's the problem of insider trading and price manipulation.
Can you define those quickly?
Sure. Insider trading is basically trading securities based on important non-public information you have access to because of your position. It's illegal because it's unfair to other investors.
Right, using secret info.
And price manipulation, or price rigging, is when individuals or groups try to artificially inflate or deflate a stock's price, often through coordinated buying or selling, to profit from the distorted price. Also illegal and harmful.
Undermines the whole idea of a fair market.
Absolutely. Another issue is sometimes seen as having inadequate debt instruments traded actively. While government bonds are active, the market for corporate bonds isn't always as deep or liquid as the equity market. This can be due to a narrower investor base, higher issuance costs for companies.
So less variety or opportunity in corporate debt sometimes.
Could be, yeah. And finally, compared to some, say, highly advanced global markets, there can sometimes be a perception of a lack of informational efficiency.
Meaning?
Meaning stock prices might not always instantly and fully reflect all available public information. There might be slight delays or inefficiencies, though this has improved dramatically.
Okay, so real challenges. What about reforms here? Has action been taken?
Oh yes, huge reforms in the capital market too. Perhaps the most significant was establishing SEBI, the Securities and Exchange Board of India, set up in '88, got its legal powers in '92.
And its job is?
Primarily to protect investors' interests and to regulate and promote the development of the securities market. It's the watchdog.
A crucial role.
Absolutely. Then the emergence of the NSE, the National Stock Exchange, in the mid-90s was revolutionary. It brought in a fully computerized screen-based trading system, or SBTS.
Moving away from the old outcry system.
Exactly. Made trading faster, more transparent, accessible across the country. A huge leap. And linked to that was the introduction of demat accounts in 1996.
Ah, holding shares electronically.
Yes. Dematerialization. No more physical share certificates. Made trading much safer, quicker, and easier, especially for small investors. Game changer.
Any other key reforms?
Well, there's been increased access for Indian companies to raise funds globally through things like American Depository Receipts, ADRs, and Global Depository Receipts, GDRs, and the creation of the Investor Education and Protection Fund, IEPF, to boost financial literacy and safeguard investor money.
So a lot of effort to modernize, regulate, and protect investors.
Definitely. It's an ongoing process.
Okay, we've looked at the money market short-term liquidity and the capital market long-term investment. How do they fit together? What's the big picture?
Well, it's clear they have distinct roles, right? The money market is about managing that immediate ebb and flow, the daily financial needs. It's like the economy's immediate bloodstream. The capital market, on the other hand, fuels the long-term growth, the investment in productive capacity. It's more like the bone structure that supports sustained expansion.
Different functions, different timelines.
Yes, but crucially, they aren't isolated. They are deeply interconnected. What happens in one often affects the other. Interest rate changes in the money market influence investment decisions in the capital market, for instance. They're two sides of the same coin, really part of one larger financial ecosystem.
So understanding both gives you a much clearer picture of the whole economy.
Absolutely.
And for you, the listener, grasping this distinction, understanding these markets, it really is a shortcut to being genuinely well-informed about the economic landscape around you. It reveals that, intricate dance of money that directly impacts your savings accounts, your investment choices, maybe your mortgage rate, and ultimately the nation's overall economic health. It's like knowing how the engine actually works, not just seeing the car drive past.
Well put.
So here's a final thought to maybe roll over as you go about your day. Think about how the ongoing evolution of these markets, the constant tweaking of regulations, how does that try to strike a balance? A balance between encouraging financial innovation, new products, faster systems, and ensuring robust investor protection.
That's a key tension.
And looking ahead, how might future tech, things like AI, maybe blockchain, how might they further reshape your own interactions within this financial system? Could they make things even more direct, more transparent, or perhaps introduce new complexities?
It's a powerful question and definitely worth keeping an eye on, seeing how financial policies and market changes connect back to daily life.
Absolutely. Keep exploring those connections. Join us next time on The Deep Dive for another exploration into fascinating topics.